What's up YouTube? My name's Dylan. Welcome back to my channel. In today's video, we're going to talk about company debt. So we ultimately want to see how much debt a company has, and more importantly, if the company is going to be able to pay back that debt, because if we invest in a company, we want them to pay their debt obligations, because if they don't, they're going to go bankrupt and our investment is going to go to zero, and we don't want that. So we want our investments to grow over time. We want to make money, we want to compound our money, and we want to retire early. So we don't want to invest in a company that is not going to be able to pay back their debt. So I'm going to show you guys two examples today. One company is in a strong financial position and they're probably going to be able to pay back their debt, more than likely, yeah. The other one, not so much. They're in a very poor financial situation and they're really going to struggle to pay back their debt without raising more capital, raising more cash, or getting some other type of financial assistance. So let's hop on the computer and I'll show you guys those two examples and give you some things to think about and some things to analyze before investing your money in a company. So we're going to start by analyzing Google. So we want to find out what their debt situation is and how financially healthy they are, and if they're going to be able to pay their debt. If they have too much, we want to find out that information. So we want to start on the balance sheet from the most recent quarter. If you don't know how to read a balance sheet, lucky for you, I put together a video on one. I'll leave a link in the description below. It kind of gives you guys all the ins and outs of a balance sheet and how to interpret it. So I recommend you check that out when you have time. So we want to calculate the company's total debt position. That is short-term debt plus long-term debt. And in Google's case, they don't have any short-term debt, so their total debt position is just long-term debt, which is just over $5 billion. Sometimes new investors mistake liabilities for debt. So think of debt in terms of your personal life. Debt is something you have to pay back with interest. So think of a mortgage, a car payment, student loans. You have to pay all that money back with interest. Same thing goes for a company. Whereas a liability may be something like a utility bill, or maybe you have a Netflix account or an Amazon subscription. Those are liabilities that you have to pay, but they're not necessarily considered debt. So whenever we're doing any of these debt calculations for a company, we want to make sure we're only including term debt and not any other liabilities. So the first ratio we want to calculate when determining the debt situation of a company is the debt to equity ratio. So that is long-term debt divided by shareholders' equity. In Google's case, we do that calculation and we get the company is 2.5% debt. So a good company is typically 25% debt and 75% equity. So Google at 2.5% debt is way better than most companies out there when it comes to its debt position. So the next thing we want to look at when analyzing debt is we want to go to the annual cash flow statement. If you guys don't know what a cash flow statement is, I put together a video on one. I left a link in the description below. I recommend you check that out as well. So first thing we want to see from the cash flow statement is we want to calculate positive free cash flow, which is cash from operations minus capital expenditures. And I like Rocket Financial because it actually already does that calculation for us. And we want to look for positive free cash flow. Positive free cash flow tells us that the company is generating cash and it's going to be able to use that cash for whatever it wants, perhaps even pay down its debt that it has. So if a company does not have positive free cash flow, that's a negative sign, because if they're not bringing in cash, they're not going to be able to pay down their debt. Next, we want to go to the annual income statement. So if you guys don't know how to read one of these, again, lucky for you, I put together a video on one. So I'll leave a link in the description below. Check it out if you don't know how to read an income statement. It'll give you guys some things to understand before investing in a company. So what we want to look at in the income statement is we want to look at this line down here called interest expense. That's the amount of interest that the company is paying on its debt. So in Google's case, they have $100 million they had to pay in 2019. So we need to ask ourselves when we look at this for a company, is that too much? Can they afford it? Can they not afford it? So in Google's case, if we look one line below that, we look at interest income. They actually had $2.4 billion in interest income. So what this tells me is that Google, from its investments, received $2.4 billion in 2019, which is way more than enough to cover their interest expense. So this is something we like to see when a company has investments that they're getting interest from that'll actually cover the interest expense on their debt. So if Google didn't make any money and just had their investments, they would actually be able to pay the interest on their debt from their investments only. So the next thing we want to look at is we want to go back to the balance sheet for the most recent quarter, and we want to look at short-term debt. So this calculation is going to be easy for Google because they don't actually have any short-term debt. But what we want to look at is we want to see if the company has enough cash and short-term investments to cover short-term debt, which in their case they do because they don't have any short-term debt. And if they don't, then we want to see if they have enough free cash flow to cover their short-term debt. So Google's in a great position. It doesn't have any short-term debt, so it's not going to have to worry about either of those. So the last thing we want to look at is we want to go back to the annual income statement. We want to compare interest expense to operating income, or EBIT. So in Google's case, they had $35.9 billion in EBIT, earnings before interest and tax, and they had $100 million in interest expense. So there's a ratio you can calculate called times interest earned, which means how many times will operating income, or EBIT, cover interest expense. And in Google's case, it's over 300 times. So ideally, we like to see this more than 1 or 2. So Google's in a great position to where their operating income, their earnings before interest and tax, will more than cover their interest expense. Now, if this were closer and it were maybe only like 1 or 2 times or less than 1, then we could go back to the cash flow statement and we could see if the cash flow or free cash flow will cover interest expense. So one of my favorite investors, Peter Lynch, he likes to calculate what's called the company's total cash position. So what he likes to do is take cash and equivalents in short-term investments, add those together, and subtract long-term debt from that to get the company's overall cash position. And in fact, this overall cash position can be used to calculate financial valuations, which I'll show you guys in a future video. So now we're going to look at American Airlines. So the first thing we want to look at for American Airlines is we want to calculate their total debt position. So for American, they have just over $28 billion in long-term debt, and they have just over $2.5 billion in short-term debt. So American's current debt position is just over $31.7 billion. That is the total debt that American has on its balance sheet in the most recent quarter. So now we want to calculate their debt to equity ratio. So we want to take total debt divided by shareholders' equity, and we scroll down and we notice, that's not good. They have negative shareholder equity. So anytime you see negative shareholder equity for a company, that's a red flag. So we automatically got a negative check mark for American when it comes to debt to equity, because we can't even calculate it because it's negative. So we can't calculate debt to equity. So let's look at free cash flow. So we go over to their annual cash flow statement, and we can see down here that the company has been operating with negative free cash flow for the past 3 years. So we saw that they have a lot of debt. We calculated that from their balance sheet from the most recent quarter. Not only do they have a lot of debt, but they're not generating any cash to be able to pay that debt. So negative free cash flow is another negative sign for the company. So that, again, this is another negative check mark for the company when it comes to how they're going to be able to manage their debt. So far, we're 0 for 2 with American. So let's hop over to the income statement and let's see how much interest expense they have. So in the annual income statement, we're looking at 2019 calendar year, and we see that they had just over $1 billion they paid in interest expense. So Google was in a great position because their interest income actually more than covered their interest expense. However, American's not in that position, so that's not going to be able to cover it. So we need to look at other opportunities to cover interest expense. So let's look at times interest earned. So American had just over $1 billion in interest expense, $3.7 billion in EBIT. So that gives us a ratio of about 3.3 times. So not terrible. That says they have enough operating income to cover their interest expense. However, we want to look at a few other things of the company. We can't take just one positive thing for the company and say, oh, good, they're in a good debt position because their operating income will cover their debt. No, we need to look at other things as well. And that's why we got to go through this checklist. We got to look at total debt. We got to look at debt to equity, positive free cash flow, cash and equivalents. We need to take all this stuff into consideration and view it holistically and not just take one piece that fits our criteria because we want to invest in the company and say, oh, they're good at managing their debt because they have enough operating income. So we want to look at a couple other things. So they have enough operating income to cover their interest expense, but what about free cash flow? So if you remember back, free cash flow was actually negative. So they're not actually bringing in any cash to the company right now, so that's a negative sign. Another negative sign is the company has actually run a deficit of about just over $2 billion for the past 2 quarters. So this is something we want to keep an eye on. Is this a trend? Because if the company is not bringing in any net income, that means they're not making any money. So you want to start digging a little deeper into the financials to get the company's true debt picture. So 2 quarters in a row, American has run a deficit, so they've lost money for 2 quarters in a row. Looking back at the cash flow statement, we see that they've actually generated negative free cash flow for 3 consecutive quarters. Again, this is a trend we need to look at to see if this is something that's going to continue or if the company's going to turn things around and be able to generate positive free cash flow. Because ultimately, if a company's negative free cash flow and their negative net income, they're not going to be able to pay back their debt. They're going to have to borrow more money or come up with other ways of financing to pay back their debt, or they're eventually going to go bankrupt, which is going to be bad for you, the shareholder. We already know Americans in a very poor financial situation because they're negative shareholder equity, they're negative free cash flow for the past several quarters, they're negative net income for the past 2 quarters. So what about short-term debt? Do they have enough cash and equivalents in short-term investments to cover their short-term debt that's going to be due this year? And in fact, you see they do. They have roughly $10 billion of cash in short-term investments, so they're going to be able to pay their current portion of their long-term debt or their short-term debt. So that's good to see. However, again, they're negative free cash flow. So if a company is negative free cash flow, ultimately that's going to be poor for the company and poor for you, the shareholder. So the last thing we want to look at is we want to go to the quarterly cash flow statement, and we want to look at investing activities, and we want to see how much debt the company's taking on. So you can see in the most recent quarter here, American Airlines has actually raised $7.7 billion in cash by issuing new long-term debt. So that's not a good sign. We don't want to see companies taking on a lot of debt, issuing a lot of debt. So this tells me that American is in tough financial position to have to try to raise this much cash in this quickly amount of time. All right, guys, so hopefully the 2 examples we looked at today gave you guys some tools and some things you can use to analyze a company's financial position and debt profile before investing in it. Because like we said before, if a company cannot pay its debt, it's eventually going to go out of business, and we don't want that for our investment because it goes to zero. So remember, invest in companies with low debt, invest in companies that make money, and also invest in companies that are preferably non-cyclical and are just strong companies and grow earnings over time, grow revenues over time. We don't want to invest in companies that don't make money, have huge amounts of debt, because ultimately they're just going to struggle to pay it back, and it's going to be stressful. We're not going to be able to sleep at night because we're going to be worried about, is the company we invested in going to go out of business? We don't want any of that. Invest in strong companies, good balance sheets, and you'll be happy. If you guys have questions, if you need help, please leave me a comment below. I'll be more than happy to help you out and analyze the debt situation of a company if you just need help with it. So if you guys like this video, please click that like button below, give it a big thumbs up. That helps YouTube promote my content and help other investors out there learn on their investment journey. I also encourage you to subscribe to my YouTube channel to see future financial and investment education videos. This is going to be your place to learn. And I also encourage you to check out my other videos, especially my series on understanding companies' financial statements, because as we make future videos and introduce you guys to future topics, it's going to be key to really understand those financial statements. So I'll leave links in the description below so you guys can check those out. So I appreciate you. Thanks for watching, and I'll see you guys in the next video. Peace.